All right, let me do a quick sound check here. Make sure that this is working okay. Hey, Java, good deal. Bueno, bueno. Fantabulous. All right, let me grab a few things here. I need to make a note here to find my bamboo stylus because that has disappeared. Find bamboo stylus pen. And all right. That's awesome. Yeah, well, what's interesting, about the price action now, and we'll get and first of all, welcome to the webinar. We'll officially get this started. And what the title of today's webinar is just called "Keep Calm and Profit." And the idea with this, of course, is that we've got volatile markets, and within the context of these volatile markets, how to keep calm and just kind of focus on cranking out trades. And I'm going to dive into this, but a lot of this stuff too is that, if you're newer to this is a really good introductory way to look at this in terms of the philosophy of how the markets work. The main thing that I see where people have gotten caught up here at the beginning of this year, especially, I mean, without a doubt, is just the idea that they get into the market with the frame of mind that something has to happen in an expected way, okay? And that's just a way of saying, like, okay, at this point, if we look at, this is a 2-hour chart of the NASDAQ, right? And if we look at, well, let's look at a 240-minute chart of the NASDAQ. I mean, the time frame is kind of irrelevant. I just want to get some of the activity of, let's see, activity back in there. Here we go. So here, here's Google, right? So the idea is then it's like, well, gosh, if here we had a strong downtrend, that means, and people get used to a strong downtrend, that means that we always have to be in a strong downtrend. And so then they stay short through these big rallies, and that rips their head off. And that's kind of, the, the long and the short of it. And if we look at the QQQ here, the biggest thing that I've found is that, when the market was going higher, all right, it's kind of like, okay, everybody's most bullish kind of at the top, and then everybody's most bearish at the bottom. And this, of course, has been an interesting rally. But what I want to point out is that the movements here are actually very, it's just repeating the same pattern over and over and over again with some wider variations. And then at some point, it rolls over to the downside and does the same patterns to the downside. But what happens is, as traders, we get lured into the false sense of confidence that, oh, stocks are just going to keep going up, we're going to buy the dip. But then we get to an extreme to the downside here, and then all of a sudden, oh my gosh, I'm bearish. This is going to 100. And we project all those feelings onto the market. We're not actually paying attention to what the market does, nor are we paying attention to the only two ways that the market actually moves, okay? And so the idea of today is to just kind of take a deep breath and get back to the basics of how markets really work, and then you can actually apply all those strategies into what's happening right now and actually kind of stay semi-calm, cool, and collected, no matter what the market's doing, okay? And at the end of the day, that's kind of the idea. We don't want to be all crazy and wondering what's going to happen next. We just want to have a kind of a very specific way that we can trade this stuff without having to guess. All right, so that's kind of where we are. And let us, okay, let me get this set up here. All right, and then yeah, if you guys have questions and things like that as we're going, just let me know. All right, I think I got all my sound and stuff like that set up. All right, so keep calm and profit. So first, welcome to everyone. I've got, I think 75% of the represented languages here. I know I've always missed a couple of them, but that's trying to get all those in there. The main thing, of course, starting off, and I know some of you guys in here have been trading for a long time, and then some of you may be just starting out. But the main thing is that, you know, trading is deceptively hard. It's the easiest hard thing you'll ever do in your life. And at the end of the day, you simply just need to be committed to succeeding. All right. We all think that success is going to look like this when we start trading. But the reality of it is it starts looking like this. And that has less to do with the markets and much more to do with trading rules. You know, how do you set up your trading rules? Are you focused on risk? Okay. What happens if the market does something that is unexpected? Okay. Which the only expected thing when you're trading should be that the market is going to do something unexpected. Yeah, I've been on that road. There are no shortcuts to any place worth going. All right, so we want to kind of keep that in mind. Now, I found this. I was rummaging through some photos, and I found this. This is my state-of-the-art trading equipment back in 2004. These are these 21-inch monitors. They each weighed 70 pounds. Okay, I had a little compact laptop here. That was my awesome quad screen setup. And then this is kind of, for the most part, I have a different office, but this is what my trading office kind of looks like today. And of course, the idea here is that you have a lot more computing power, the screens are better, everything's faster. And, you know, the idea is like, well, okay, great. Does that give you much more of an edge? You know, does the technology improvement help? And honestly, don't think it does. I think that it's a falsehood to say that just because you have faster stuff means you're going to be a better trader, and it really actually has nothing to do with it. So faster and better technology does not make the retail trader's job any easier. If anything, it allows for more information overload than ever before, which means we get more paralysis by analysis, okay? Meaning you got so much stuff coming at you, you don't even know what to do. So the key is to understand the philosophy of how the markets work and the best way to get in sync with that flow. Okay, that's really our goal as a trader, is just to be in sync with that flow. When you are out of sync, it just gets very, very difficult. And it's actually, once you kind of get out of sync, it's actually hard to get back in sync unless you are aware of what's going on. If you're unconscious of it, and most people are unconscious of it, it just becomes an exercise in frustration. Yeah, it's like having a faster car. It just means you get into trouble faster. And then you also want to be able to protect yourself from yourself while you're doing all of this. It only takes one, you know, I always, you know, so a false analogy of the markets is that, oh, you got to be careful of the rogue wave. Okay. No, the right analogy is that you're setting yourself up so that if a rogue wave happens, you're not going to get destroyed. All right. So that, you know, that means a couple of common sense things, which we'll get into. So one of the things to keep in mind too is that if you are unaware of this, your brain will take over your trading. It will not help you. Okay. For people who are unaware and unconscious of this, this is automatically what happens is you get into a trade, you start off with optimism. Okay. As if it's going profitable right away, that turns into excitement and then thrill. And then you have this emotion called euphoria. This is about the time you start building out a spreadsheet and showing that, gosh, if I made $10,000 a day for the next, 10 years, I'd be a billionaire or whatever it is. And at that point, you're in the highest risk because you're under the delusion of, these godlike abilities to time the market when you just happen to catch this wave. And then the market starts to pull back. That creates a little of anxiety. And then at the denial point, that's typically when it's like, well, I don't want to get stopped out here and take a small profit because I'm leaving all this money on the table. That's my money. And so as soon as we come back up here, I'll get out. And then we come down to break even, and you get into desperation. Now it's panic. Like, okay, just come back to my break even point, and then I'll get out, I swear. And then it starts to come down, and then despondence, and then finally capitulation. All right, and then it's just kind of that. It's that process. And again, if you're unaware of it, that's what's guiding your trading. Okay, that's the market is automatically triggered to suck in your unconscious brain to react like that, and that's why people have small winners and big losses. Okay, they learn to take that little profit as quickly as possible so it doesn't turn into a loss, but that at the same time they're willing to hold on to a huge loss with the idea that maybe, just maybe, it'll come back and turn into a small profit. And again, if you're unaware of that, that's just what's happening. Okay, so let's talk about what a trader's job is. A trader has one job and one job only. Okay, and believe it or not, it's not to be right, It's not to analyze correctly what is going to happen next, okay? It's not to call the top or call the bottom. It's not to stare at 5-minute charts all day with the fake realization that you're getting an edge, okay? It's not even staying up to date on the latest news. A trader's main goal is very, very simple, okay? And that is to work on creating an equity curve that goes from the lower left of your screen to the upper right, all right? And that's it. That just means that this is your starting balance at the beginning of the year, and your only job is that it gradually works its way higher into the end of the year, okay? Anything that interferes with that needs to be cut out. Now, what's the biggest thing that interferes with that? Trades that aren't working, okay? So your number one job as a trader is to kill trades that ain't working, okay? And so if you look at it from that, most people that haven't thought about this don't even understand that that is a job of a trader. Oh, it's like, don't you just set up a stop? No, it's you're actively looking at trades that aren't working, and you're actively killing trades that aren't working. And in fact, that is your number one job as a trader. Okay, your number one job as a trader. It's not looking at charts. It's not reading the news. Okay, it's not looking at order flow. It's killing the trades that aren't working. And once you get your arms wrapped around that, your trading changes. This becomes a lot less unemotional and more of just like, at a job at a factory, just killing the trades that aren't working. Your number one goal. And really, if you think about it, nothing else really matters, because if your number one goal is killing trades that aren't working, then your number two goal is to let the trades that are working work, let them work, and then all of a sudden, that's all you got to do. You can either be right or you can make money. Okay. Do not focus on being right. That'll kill you. All you got to do is kill trades that aren't working. That's your number one goal as a trader. And then number two, if they are working, learn to manage them effectively, trail stops, et cetera, et cetera. Winning traders care only about the size and shape of their equity curve. The other thing to be careful of is what I just call FOMO, which is fear of missing out. And a lot of times what happens is traders get bored, and this is the trade that they're in, their current trade, right? And then they see a new potential trade that looks sexier. And so they get out of this trade that they're in and go into this new trade only because it's quote unquote moving that day. It doesn't even have a setup, okay? And that's the thing, is traders get sucked into this idea that, oh, I want to be in the stocks that are moving today. And it's just not true. You want to be in setups and be in them already when the move happens. And so you've got to be able to identify the ways that the market moves and the setups that are good for that. All right. So at the end of the day, your self-control level needs to be expert in order to do this. If you have a problem with self-control, you would at least want to acknowledge that. Okay, so what are some signs that you have a problem with self-control? Are you doing like 20 trades a day? That's a problem with self-control. If you are, taking profits way too fast and letting your losers run, that is a problem with self-control. All right. Again, just kind of going back to the basics here, it will help a lot of traders out. So my point of view on this is that a full-time trader doesn't mean having to know everything there is to know about the markets, okay? And it certainly does not mean trading all the time. It is just knowing what works, what keeps you on course and in flow while everyone else is pulling their hair out, all right? It's like swimming. You don't have to touch every part of the ocean to enjoy the water, just like you don't need to be involved in every move in order to enjoy trading. You just need to be able to recognize when a wave is coming towards you and be prepared to duck beneath it or strap on and ride it into shore. So at the end of the day, do you want to be right or do you want to make money? Okay, let's keep it simple. So what we want to do is just kind of understand how these markets work. Now, a large part of what I do is options trading. If you trade options, that's great, but you don't have to, okay? Everything I do is 100% directional based. So what I mean by that is if you have a directional based setup, that means if you've got a setup where something's going to go higher, then great. You can buy the stock. In this case, this is Chipotle stock, okay? Or if it's a futures contract, you could buy, the S&P futures, whatever it is. But let's assume in this case that you're analyzing Chipotle, which is CMG. So basically, there's three main ways to trade this. One, you can buy the stock, okay? You could buy a call option, okay? Or you could sell put options. That's the basic kind of trading 101. Now, a couple things on this, of course, is that, first of all, if you buy the stock, you're going to tie up a lot of capital. 100 shares of stock at $554, that's going to, it's $55,000 of buying power that's tied up. Whereas on the other hand, if I bought one option, which represents 100 shares of stock, in this case for $10, that only takes up $1,000 of buying power. Okay. So that's the difference here of, so, oh, I guess that's $1,000 versus $55,000. So you can see here that in this case, when Chipotle's is going up, on the stock, I'm making $1,049, and on the option, I'm making $990. So it's comparable. It's not going to be exactly the same because there's a little bit of premium decay here. Now down here, and I also sold the 550 put for $2. Here you can see it's worthless. So in this case, I'm going to make the entire $200. All right, so what are the pros and cons of this overall? Now, first of all, that's a naked put. Of course, you could have less risk if you just did it as a spread, okay? And that's always a possibility. But the main thing here is that, you know, in this case, because Chipotle's had a nice move higher here, okay, boom, it was a great move up. These directional trades worked out great. However, had it traded sideways, okay, then, you know, this wouldn't have made any money. This would have lost money, but my put could have still made money. Long story short, there's different ways to kind of trade the market, but all the basis of my decision is based on the underlying making a specific move, okay? From there, you can decide how to trade that, whether you want to buy stock, you want to buy calls, you know, you want to sell puts, if they're bullish plays, and then if they're bearish plays, you can short the stock, you can buy puts, or you could sell calls, all right? And that's just basically the, you know, a thumbnail view of kind of how I trade. So, and the other thing I like to kind of look at too is just the idea of, you know, and I'm a big fan of a tool called the squeeze. And here's a squeeze that's setting up, and this was on when this was still a company, Starr. I think it's traded, it's Redbox now or something like that. But a lot of times, you know, I got in the squeeze here, and so I'm just sitting here for like weeks and weeks and weeks. And so my long call here, you can see I bought it at $4.70. And it's just kind of sitting there. In fact, I'm down $150 on that trade because the trade has gone sideways. Okay, and in that case, I'm getting what's called premium decay. However, when this put that I sold for $1.06 has actually been making money, okay, in premium decay. So what's interesting here is that here I am. I took both of these trades at the same time, okay, and in a sideways market with the call option, I'm down $150, and with the put option, I'm up $500. And you can see it's the same strike. So again, this is just kind of the understanding of options and premium decay and stuff like that too. And once you learn about it, of course, it can be a little bit of fun. All right, so let's dive into this. So again, we've already covered this. Markets move on waves of emotion. I think anybody in here has probably experienced something like that. And if you haven't, as long as you're aware of it, that's important. This could even capture the market in September. All right, so here's the market going into the end of September. We hit October, November, December, right? And now here we are in January with a little bit of a bounce. And you can almost kind of map out all the stuff, the denial, fear, depression, panic, capitulation. And now, you know, of course, everybody's bearish at the bottom and everybody's bullish at the top, right? And so that's just kind of how the markets move. And typically we see that on an intraday scale, but you know, lately over the last couple of months, we've seen that on a daily scale. So the market ebbs and flows emotionally, but it ebbs and flows all the time. So even in a quiet market like this, you're going to see ebbs and flows where these emotions are taking shape just on a smaller scale, less intense, okay? But these same ebbs and flows happen on uptrends and downtrends. It's just that the intensity behind the moves are stronger. So in an uptrend is typically a little bit more gentle slope, as we saw in October, November, December. Downtrends can be a lot steeper. The saying is that the markets take the stairs up and the elevator down, all right? And that's just how they work, because people kind of gradually buy. It takes a lot of energy to move a market higher, but all that has to happen for the market to move lower is for people to stop buying. And then, of course, when you add real selling onto that, you get some doozy moves. All right. Now, if you look at one of my favorite charts is you get like, if you're just trying to figure out the trend, I'll look at a 78-minute chart. An hourly chart is just fine too, but it gives you a really good bird's eye view of what I would just call the intermediate term trend. You know, daily chart to me is kind of the longer trend. Of course, a 5-minute chart is a really quick action, but the same thing. You can see all the emotional ebbs and flows here, right? So you got euphoria, despondence, euphoria, despondence, and you can see it all, and it actually moves very, very orderly. A lot of times people think when the markets are down or they're crazy and stuff like that, they're like, oh my God, this stuff's going all over the place. I don't know what's going to happen next. Throw up a 60-minute chart, put up some trend lines, you're going to see that it's actually very orderly. You just got to get in sync with the movement. If you are not in sync with the movement, it is going to look like it's pretty crazy. But the thing I want you to remember here too is just, we're going to talk about this, but the markets always come back. So it's like, wow, here's this huge disaster move to the downside, yet it comes back here for some reason, all right? Disaster move to the downside, yet it comes back here. Disaster move to the downside, yet it comes back here, right? This process always happens, and we'll talk about that. So the market ebbs and flows. So the markets are always ebbing and flowing, and they are always ebbing and flowing in one of three patterns. Okay, it's either sideways, as an uptrend, or as a downtrend. And all three have different sets of emotional intensity, which is why down moves are often faster than sideways or up moves. And by the way, in a down market, rallies are best in down markets, because when you get a rally in a down market, you're getting short covering as well as buy the dippers. That's why we had a 1,000-point up move in the Dow. Was it January 1st or whatever day it was? I don't even remember. But you don't get a 1,000-point move in a bull market. You get a 1,000-point move in a bear market because you get the panic of short covering as well as new buying. So believe it or not, when you get a down market, I'm always looking for long signals because they are the most fun longs to trade. Also, understand the trading cycle. Okay, the trading cycle, which is basically strong, smart, and dumb money. So accumulation is smart money. You get the markup, okay, and then distribution. All right, so where is the strong, smart, and dumb money in all this? Okay, the dumb money is buying at the top. It's just because they've been waiting so long. It's like, oh my God, oh my God, oh my God, oh, finally I'm going to get it. All right, versus, versus that too. So it's just kind of keeping in mind where we are. What is the smart money doing now? Okay, are they getting out of stocks, which is distribution, or are they accumulating stocks? So at the end of the day, there are only, believe it or not, with the thousands of indicators that are out there today, there really are only two types of trading. Okay, only two types of trading. Reversion to the mean, which by the way is the highest probability type trading, but you can get some things that kind of really run away without you. And explosion, implosion away from the mean. Okay, what does that mean? So that means here's the mean price, which is typically a moving average. So either price is up here and it needs to revert back to the mean, okay, or price has been hanging around here and it needs to push away from the mean, okay? You're either trading back to the mean or you're trading away from the mean. That is it. That is the only two types of trading that there are. And if you're conscious of that and you're aware of it, you can set up your trading accordingly. Okay, so for reversion to the mean trading, what I'm looking at is an 8-period moving average and a 21-period moving average. If we have a strong trend up, okay, or a strong trend down, and that's to me is defined by the ADX. Okay, basically ADX over 20 is a strong trend, and then over 25 is a super strong trend. So, if the ADX is like over 25, then the 8-period EMA is going to be a reversion to the mean. All right, and here we can just. And I always say a picture is worth 1,000 words. So let's look at, let's go back here and look at the cues. So, we can see here that, so if we look up here, the yellow line is the 8-period moving average and the white line is the 21. Okay, if there's a strong move up, okay, up, markets have to come back to the 8 EMA. Okay, up, markets have to come back to the 8 EMA. And then, or sometimes they come back to the 21 EMA if the trend's taking a rest. Okay, but a strong move down has to come back to the 8 EMA. Strong move down, back to the 8. Strong move down, back to the 8. Strong move down, back to the 8. All right, and you can see right now what's happening is we've come back to the 8 and to the 21, and now we've got moving average crossover. So we're starting the process of potentially continuing to work our way a little bit higher. Yeah, so basically I use EMAs, but to be honest, whether you use an EMA or a SMA, I don't think it makes a difference. So a 21 SMA versus a 21 EMA is in the same ballpark, if that makes sense. So I've always used EMAs just because that's just kind of how I was trained. But I've also looked at SMAs, and I don't honestly think one is better than the other. So I think it's just preference. All right, so one of the things here is at the end of December, and this is where everybody was super bearish, but I'm like, this is the worst place to get short, okay? That's the worst place to get short. That's the worst place to get short. That's the worst place to get short. Why? Because they're going to have to snap back to the 8, okay? So the best place to short on something like that is if you get back to the 8 EMA, you can short with a stop loss, right? Maybe it works, maybe it doesn't. But, you know, just like up here, you don't want to buy right there. Buy the pullback to the mean. You don't want to buy right there. Buy the pullback to the mean. You don't want to buy right there. Buy the pullback to the mean. All right. So same thing in reverse. Oh, awesome. Thanks, Stewie Beats. Yeah, awesome. So, no, it's always good too. And I always like the idea we get to share, you know, share different ideas and things like that too. So the DEMA as well. All right, so, and that's awesome. I'm not getting any data from TradeStation, so that's working solid. So from here, then, let's take a look at what this looks like. So here's a daily chart of Tesla, and this has the 21 period moving average on it, okay? Now, if you look at this price action, you'll see, man, it gets pretty far away and then snaps back. It gets pretty far away and then snaps back. It gets pretty far away and snaps back. And if you've never really considered that before, when you look at this, it's like, wow, that's actually pretty orderly. Okay, it doesn't mean it's like, you know, it's just, but you know, it always comes back no matter how crazy things are. Okay, so that's the first thing to notice how, and I call this sea level. Okay, it's like the tide, the rising tide, the falling tide. It always kind of comes back to sea level. And so if I say sea level, what I mean in this case is that 21 period moving average. And again, remember, most of the time, that's what I'm looking at is the 21 period moving average. If the trend is exceptionally strong, up or down, then I'll look at the 8. And again, I just kind of, you know, I look at that 80X, or, you know, you can kind of get a sense, is this market just kind of running away or not? So price always reverts back to the mean. So the question is, how far away does it get from the mean before it wants to head back? Okay, so it's one thing to say like, okay, yeah, it's going to go away from the mean and come back, but on average, about how far away does it get before it starts considering a return trip? All right, how far away does it get before it starts considering a return trip? That's another way of saying, how far away does it get before black box systems start taking the opposite side of the move in anticipation of reversion to the mean, okay? Because a lot of black box systems out there trade reversion to the mean because it is the highest probability way to trade. So this is where the concept of what's known as average true range becomes incredibly helpful. Average true range is simply the average price range of this stock over the course of X number of days. I like to use either the 14 or the 21. Again, I've used both. I don't see a huge difference in both. For a while, I used the 21. Then I kind of went back to using the 14 as things got more volatile. Again, not a big difference in either one. But here's the deal. Like right now, I'm using the 14 period average true range. As a rule of thumb, if price gets 2 average true ranges away from the 21 period moving average, it will then want to return to sea level. All right, so that was a mouthful. So what do I mean by that? All right, well, you can look here. I put on the average true range, okay? And so you can see that the average true range value changes, right, as the volatility changes. So here, the average true range dropped down to about, $4. And up here, it was closer to, well, I have it up here. So here you can see the average true range of Tesla. When the ATR is at $4, okay, and this is the important part. So if the average true range is $4, all right, so down here it was $4, then if it moves 2 times that away from the 21 period moving average, in this case $8, it will tend to want to return at that point, okay? Now, if volatility increases and the average true range jumps to $12, okay, and so you can see here it's $12, then if it moves $24 away from the mean, so here it's about $24 away from the mean, then it'll want to return to sea level. Okay, This is why one of my #1 rules in trading is this: I do not chase moves that are 2 ATR away from C level. Okay, so if I see a stock like right here breaking out and it's only 1 ATR away from here, great, I'll buy it, because it's got the opportunity to move another 1 ATR, which in this case is like another $9. That's tradable. Okay, but does that make sense? If you're looking at this and saying like, okay, right here on Tesla, we're 2 ATR away from the mean, is this a good place to short? Okay, no, it's the worst place you could ever short. Okay, here you are, 2 ATR away from the mean, the upside. Is that the best place to buy? No, it's the statistically worst place you could ever buy. So what's great about knowing this is that it also keeps your emotions in check. All right. And that's always helpful, because remember, if we're unconsciously not aware of that, our emotions will take over. Do the Bollinger Bands show the same? So they don't. You have the right idea, Skip. It's just that average true range measures something different than Bollinger Bands. All right. So you're right in that it's the similar idea. The main difference, and I love the Bollinger Bands, by the way, but I use them for something different. Bollinger Bands focus on statistical standard deviations. So essentially 2 standard deviations away. And what happens, well, let me back up, because you're not, I want to be clear, your question is a good one and it's not wrong. It's just you could actually put Bollinger Bands up here instead of this. Just keep in mind that Bollinger Bands are not measuring the average true range. They're measuring what is 2 standard deviations away. Does that make sense? What I'm going to show you is something called Keltner channels, if you're familiar with those. And so for this particular purpose, I like to use Keltner channels, but Bollinger Bands are complementary to it as well. Okay, so Captain Kirk, yes. Can the 2 ATR be applied to any time frame? Absolutely, yes. And we'll kind of get into that. Okay. Oh, what is C level? So sorry for those of you that are just joining. So anytime I say C level, which I know sounds kind of weird, I'm referring to the 21 period moving average. So it's essentially reverting back to the mean. It's returning to, I just call it returning to C level. I like the ocean a lot, so I use a lot of ocean references. Okay. So let's do this. Oh, how do I tell that that's $4? So on the platform, so you can see right here, it's actually $5 right there. So normally it's labeled. In this particular one, I took the screenshot, it just wasn't labeled, but okay. So luckily, we do not have to eyeball these levels. We don't have to sit there and stare at a chart and say, gosh, is that 2 ATR away? We can plot them very easy with Keltner channels. All right. So on Keltner channels, what you do is this defaults, I think, to 20 and 1.5, which is okay. But I go in and change it 21 as the length, and then 2.0 as the number of average true ranges. All right. So that's 2 times the ATR. So now you can visually put this on the screen. So now we're looking at the same chart, right? And we're seeing things a little bit more cohesively. Now, of course, you're going to see weird anomalies like this. That's just called trading. And yeah, there's going to be times when it pushes back a little bit, all right? Again, that's just called trading. Now, there's sometimes we get something called a squeeze where we know in advance that it's most likely going to push through that, but that is the next section. But just keep in mind, if there's not a squeeze and things are just going along, okay, this is bread and butter trading right here. You rally up here, and it's like, well, guess what? We're 2 ATR away from the mean. We're most likely going to revert back, okay? We come down here, we're 2 ATR away from the mean. We're most likely going to revert back. If you're into options, this is a great way to sell premium. When you're up here, you sell call credit spreads. When you're down here, you sell put credit spreads, okay? Does that make sense? Again, visually, it's always, you know, everyone's looking for the perfect thing. It's not going to always be perfect, but if you've not been introduced to this concept before, it will save you a lot of anguish. Awesome, Candy. So, and then when you combine this with squeezes, it gets a lot more interesting as well. All right, so So from here, somebody asked earlier, does this work on intraday timeframes as well? And the answer is yes, absolutely. So if you trade like the S&P futures, perfect. Here's Amazon on a 30-minute chart, okay? So Amazon on a 30-minute chart. So here's our ATR, average true range, and we can see it's like, okay, you know, right now, right here, average true range is $7.50. So these bands are automatically plotted 750 times 2. So now we can see it's like, okay, great. Now you're going to get weird moves like this with squeezes. So you kind of sometimes got to let it settle back in. But again, if you're buying here and it pops up here, there's no reason to expect that it's going to go up here. You take your money because the odds have increased that it's going to revert back to the mean. Okay. And then the next day, if you rebought it here and it pops up to right here, get out, because the odds are that it's going to peter out and go back here. So once you start looking at the markets like this, suddenly things become a lot more orderly. And you know, without a shadow of a doubt, you never would buy that. Okay? Why would you do that to yourself? Wait, just place an order. Just place a limit order to buy the next pullback here and go to the gym. You'll save yourself a lot of angst and frustration. So all right, hold on. I just got a note here. All right, Ralph, on the Tesla chart, price action was following the 2 ATR lower KB. Does a change in the ATR? Okay, no. So does a change in the ATR become a signal that price may start to revert to the mean? Not necessarily, Ralph. It's a good question. I haven't spent a ton of time on that. But the idea with this is, if you think about how the ATR works, and it's actually a very interesting question, is that, so let's look right here. So basically, if the ATR is here, okay, and starts to pull back, basically what it means is that we just went from a wide range and it's starting to quiet down. All right, so here was a wide range, and that's built into this average. You can see that the average has increased, right? And now it's starting to decrease. Honestly, I have not spent a lot of time looking at if this is curving, does that mean we're falling? So it's probably worth some study. I just kind of plot the levels. Okay, and then so in sum, within the context of an uptrend, downtrend, or sideways markets, we understand the concept, you know, thrust and reaction. So this is what I always look at as, you know, you kind of get you get the thrust up and then the reaction down. Okay, and in an uptrend, guess what? In an uptrend, this midline here is going to be continually rising. So we thrust up and come down. We thrust up, we come down. And we're coming down to that continually rising midpoint. A downtrend works the opposite, right? We thrust down, we come up to the continually falling midpoint. So again, suddenly these sideways markets and uptrending markets and downtrending markets, they're all doing the same thing, okay? They're just the angle of the trajectory is different, but it's doing the same thing. All right, so hopefully that makes it a lot easier. So what we want to do now is, you know, we started talking about reverting back to the mean, which is a great way to trade. I love that. Okay. Now, the main thing with this is that reverting back to the mean is slow. Okay. You don't have big moves. As you notice, you get big moves. Well, here, let's come back here a little bit. Okay. So you get big moves away from the mean that happen very quickly. So here, again, 30-minute chart, it took about 2 hours to get to the top of the band, probably a little less, but then it took like 8 hours to revert back to the mean. That's pretty typical. This is the thrust, this is the reaction. Okay, the thrust is always more powerful. Okay, of course, that's the same is true on a downtrend as well. Again, it's just, you know, most of the time. So the question now is that, okay, we've learned about reversion to the mean and the idea that if it gets too far away, that it'll kind of drift back, right? But what about the big thrusts into the mean, the big thrusts away from the mean? Okay, how do we trade those? So again, 2 ways to trade. It's either reverting back to the mean, or it's exploding away from the mean. All right, so what we just talked about was identifying a stock on any time frame that's far enough from the that key 21 period moving average that it's likely to terminate that move and start reverting back to the mean. But now what we're interested in doing is looking for trade setups that are at the mean and are setting up to explode away and take that journey to 2 ATR away from the mean, because that's typically a faster move, and we just want to be able to identify the moments in time when that might happen. Okay, quick question from Skip. These are short-term trades using options. Well, it is, Skip, depending on the time frame, right? So on a 30-minute chart, it's going to be shorter term, but you can do this on a weekly chart, on a daily chart as well. But if this is for a short term, what delta or strike do you consider an option on a short term trade? So on a short term trade, I typically, if I'm going to do a straight directional option like buy a call or buy a put, I typically prefer in the money, typically delta 70 or higher. And if it's a Wednesday, and let's say it's Wednesday, right? And you got an option series, you got options that expire in 2 days, and you got options that expire like in the end of the next week, like 9 days. Even if it's a day trade, I typically like to give myself a little bit more time. So even if I'm only going to be in the trade for 3 hours, I typically will go to that next week just to minimize the premium decay, okay? Or if I'm going to do a swing trade, and let's say I'm only going to be in it for 3 days, I typically will go out and buy an option 30 days out, again, just to minimize the premium decay, all right? You don't have to do that, but I call it giving the gift of time. Because if you don't, and the stock's not moving, you just get killed on that premium decay. But if you go further out, even though the stock is a little pricier, the theta decay doesn't play a huge part in it, okay? And of course, you could also sell premium, right? Does this hold for futures? Absolutely, yes. Very much so for the S&Ps. Yeah, the stock indexes, honestly, like the stock indexes, commodities, they react a little bit better to this because individual stocks are also going to have that, they'll have news that could throw them completely off course. But indexes and ETFs actually tend to follow this a little bit more cleaner. From Jim, John, if the ADX is very high, should you use the 2 ATR off the 8 EMA? Yes. So if the ADX typically, Jim, is over 25, I will use that 8 EMA. Absolutely, yes. Makes sense. Yeah. Yeah. Now, and Skip, you could do at the money, right? But I just prefer that. I'm sorry, you could do at the money, especially if it's working right away. I just prefer that in the money just to kind of minimize. It's just minimizing the premium decay. And then if you know how to structure trades that are theta positive, so you could do a call debit spread or a put credit spread too. That's also a bonus. One thing I like to do is, like we just did this in Tilray, the weed stock, is that you could buy a call. So let's say, you buy, and I can't find my stylus here. So say you buy 3 calls, right? And you got really high implied volatility on there. Well, then you could sell, a 10 lot put credit spread. And then that helps to offset the premium decay. So if you've played around with options for a while, there are some fun ways to do it. But I'm totally fine just doing directional options too. Okay, cool. So let's dive in. So let's do this, and we'll continue answering questions here. So what I want to do right now is to, for the 8 EMA. Well, that's a good question. So do we adjust it for that as well? So if we do that, let's do this real quick. I'm going to get rid of all this stuff. Let's do so we don't need that, and let's get rid of that. So I'm just going to have let's add the ADX, and let's add 2 sets of Keltner channels. And then let's add let's do that first. So let's do 2.0 and 8. Okay, and then let's do, let me see what color those look like. All right, so now we just want to know, okay, let's come back in here real quick. I can give you guys a copy of this if you want it. This is a good question on the fly. So for the 8 period, I want to do the upper band. Let's make it let's make it blue. Okay, blue, and then for the average, let's make it blue as well, because we'll know it's in the middle. All right, so that's a little noisy, right? So, and sometimes it's helpful to have this on two different charts, but let's do, for this one then, upper band, let's do the average as purple as well. So the idea with this then, and you can see if you've got them both on one chart, it just gets a little, it gets a little goofy. But the idea then is if we go, all right, let's add the moving averages here. So moving average exponential. And so here's the 21. And on this one, I'm going to make it white. And let's just make it really wide so it stands out. And then on this one, we'll make this the 8. And then I'm going to make this really wide so it stands out as well. Okay. So now you got to remember the colors, but in this case, it's like, okay, if it's a strong, if the ADX is, and if, for those of you that are, if you haven't traded the ADX, how the ADX works basically is if it's over 20, it's considered a strong trend. So if I put a quick horizontal line on this, and let's do like right here at 20. So right here, if it's over 20, then basically I would use the blue, right? So the blue is the 8 EMA. So then it pulls back to the 8 EMA, okay? And then if it's like under 20, then I'd be using the 21. So again, it's a little bit of a cluster because this is all on one chart, but basically you could have two different charts and just say, okay, if it's over, if it's over 21, in fact, let's just do this. We've already seen what it looks like with the 21, so I'll just come over here and just say, all right, I'm going to disable, and then I'll disable the 21 period moving average as well. And so now we should just have the 8 period moving average and then the 8 period Keltner channels. All right, so now you can see it makes a little bit more sense. So it's like, okay, we've got this strong ADX, so if we get here, we're going to come back to the 8. If we get here, we're going to come back to the 8. If we get here, we're going to come back to the 8. If we get here, we're going to come back to the 8. Does that make sense? So that's just kind of what I mean. If it's down here, then it's going to be a little sloppier. So you're using the 21, and most of the time it's actually down there. And if it's up here, you're also focusing on the 8. Yeah, and Fedster, DI plus and minus, I'm a big fan of those too. So you can take a much deeper dive into this, of course. And we're kind of scratching the surface, but especially if these concepts are newer to you. All right. So basically the idea there is reversion to the mean. And if you aren't sure, all you got to do is use the Keltner channels with how they're displayed here on a 21 period moving average, because those will also work in any market condition. If you want to refine it, if the trend's getting a little strong, you could instead use the 8, but it's okay to just use the 21. Okay, so now let's talk about the next part of this, which is moves away from the mean, okay? So this is, now if you guys use Thinkorswim, this is a study that's built onto there. If you go to add study, you'll find a section called John Carter Studies, that's me, and then something called the TTM squeeze, all right? That's what the TTM squeeze is. And so what we wanna do is talk a little bit about what this means, all right? Now, earlier, I think it was Skip asking about the Bollinger Bands. This is how I use the Bollinger Bands, okay? So what this is the red on here, okay? So the red is the Bollinger Bands and the blue are the Keltner channels, all right? So what I'm looking for is that, so red basically measures volatility, okay? So if the red bands are far apart like this, all that means is that volatility is crazy right now, okay? But when the red Bollinger Bands actually start trading inside of the Keltner channels, all that it means is that this market has gotten so quiet, okay? It's gotten so quiet that it's actually building up energy and it needs to release that energy. And guess what? When it's building up energy like this, it's always doing it at or near the mean, okay? So you can see here, it's like, man, here's this buildup of energy and then we explode, okay? Here's a buildup of energy and then we explode. Here's a buildup of energy, okay? And then we explode. And so the nice thing is that when a market's back at the mean and it has a squeeze, which by definition is the Bollinger Bands have narrowed to the point where they're now trading into the Keltner channels, you've got this nice, unique situation where there's a buildup of energy that's going to be released in a predictable fashion, okay? So now all we got to do, and then we add a momentum oscillator at the bottom to help decide whether that energy is going to be released to the long side or the short side. All right, so now here's the indicator. So for a long time, when I would do this trade, I actually just looked at this. And then over time, we figured out that we could create a tool that would make it visually easier to spot. So basically, when the Bollinger Bands have narrowed to the point where they're trading inside the Keltner channels, that's what the red dots are, okay? So that's what I call a squeeze. The first green dot after the series of red dots just means that the Bollinger Bands have now popped back outside of the Keltner channels and the energy is officially being released, okay? And you can see from this point on, this stock had a nice steady move higher, okay? Basically away from the mean. This histogram here, as long as this histogram is going higher, it basically means that the momentum is still carrying the stock higher. And then when you get a loss of 2 momentum bars in a row, the trade is over. So it's a nice, simple trade. If you get the red dots, okay, in an uptrend, you start accumulating stock, you start buying calls. Once it triggers, you typically have a window of about 8 to 10 bars. So on a daily chart, that's about 8 to 10 days. If you're doing this on a 1-minute chart, the same concept applies, but it would just be an 8 to 10 minute trade. And then it's officially over when you get a change of direction in the bars, okay? Here we are again. Here we see the dots. We accumulate our position. It triggers, run. We lose momentum there, and we get out of the trade, okay? The stock moves from 105 to almost 120. This is great if you're long stock options, if you're long the stock, or you sold puts. And then again and again. So the idea with this is that, yes, exactly. So if you, depending on your trading style, if you do this on a weekly chart, that means that when it fires, you're going to be in that trade for 8 to 10 bars, which is 8 to 10 weeks, okay? On a monthly chart, you can be in that trade for 8 to 10 months. So the beauty of this is that the signal will fit whatever trading style you like. Now, I personally am not a fan of using this like on a 1-minute chart or a 5-minute chart. I look for trades that have a little bit more meat on the bone. So I tend to look at 30-minute charts as my lowest time frame. It'll keep you out of a lot of the noise, okay? 30-minute charts, 60-minute charts, 2-hour charts, daily charts, et cetera, et cetera. Sometimes I'll do like a 5 or a 10-minute squeeze, but I kind of like to wait for those kind of bigger ones. So yeah, now if you're doing day trading futures, yeah, I wouldn't go lower than 5 minutes. If you like tick charts, I actually like them on tick charts as well. So when I have a long squeeze, that's where I'd like to get like so let's say we're talking earlier about, okay, let's say we've got a daily chart, all right, and we've got a squeeze, and remember the average squeeze lasts, let's call it 8 bars, okay? So if I'm going to buy an option, in this case, that's a call option, even though I'm only going to be in the trade for 8 to 10 days, I still will get an option that's 30 days out or more, okay? And the reason for that is because I don't know exactly when the red dots are going to fire, right? And also, it minimizes premium decay. So one of the biggest mistakes I see that people make in this situation is that they see a squeeze, but then they like buy an option that expires in 4 days. Well, it's like they don't even give it enough chance. So that's just one thing to be careful of. And then if you do understand premium selling, I mean, there's a lot of stuff that you can do within the context of that as well. Okay. But again, very, very simple stuff where you've just got, you have a big move up, you're consolidating. This consolidation is building up energy, and then boom, you get the release of energy. And what's great about this is that I kind of don't care what stock I trade at this point. I just look for situations where I was like, oh, here's a squeeze. What stock does it happen to be? Oh, it's Home Depot. Awesome. I don't care if it's Home Depot or Boeing or Amazon or Facebook or whatever. I am just looking for that squeeze. All right. So, so how long does the squeeze usually last? It usually lasts 8 to 10 bars. Sometimes it'll last 12 to 15 bars. Sometimes it'll last like 3 or 4 bars, but the vast majority of the time, that 8 to 10 bar window is pretty accurate. So as an example, a daily signal, 8 to 10 days, a 5-minute signal, you're in for 40 to 50 minutes. All right. And then from there, the idea if it's going to fire long or short, I'm a big fan of moving averages. So if the moving averages that you're using, all right, and then I use the 8, the 21, the 34, 55, and 89, but you could also use the 10, the 20, the 50, the 100. It doesn't really matter. But if the moving averages you're using are all stacked positive, where the smallest ones are on top and the largest ones are on bottom, that's bullish. And if you see a squeeze, this is a trend continuation indicator, then you're looking for this to go. It's about an 85% chance that it's going to continue going to the upside. Okay. So ideally here, now remember, what did I say before? Okay. Reversion to the mean. Okay. So here, Home Depot went away from the mean and came back. This time to 8 EMA because it's a super strong trend. Away from the mean, came back. Away from the mean, kind of came back. This time came back to the 21. Is there any signal here that we're going to push away? In this case, no. Okay, there's not always going to be a squeeze. So in this case, fine. I'm going to wait. Okay, we move away from the mean. Great. Maybe I could short it. This time, though, when we come back to the mean, we are starting to build up energy. Okay, that means we're looking for an explosion away from the mean. Okay, now a couple things with this. There's a saying I have in trading. It's don't fight the squeeze, because the times that you see the market blow through like Keltner channels, it's right here. Right, this actually changes the direction of the Keltner channels higher in this case. So when the market's quiet and there's no squeezes, guess what? Yeah, we just bang back and forth between those Keltner channel levels and reverting back to the mean, but a squeeze will actually blow through those levels. Okay, so the biggest mistake I've seen reversion to the mean traders make is they don't understand this concept of a squeeze, and so they just happily short this move into the mean and they get destroyed because it keeps going and going and going and going. All right. So even if you elect not to trade squeezes and you prefer the reversion to the mean strategy, always know if there's a squeeze that's fired or not, because you got to wait for that squeeze to run out of momentum, as it does right here, before you employ your reversion to the mean strategy. All right. Okay. So from here, so key takeaways. The market makers always price in expected moves into the price of the options, if you guys are familiar with expected moves, but they do not take into account a squeeze. This means that at the money and out of the money options are cheap because they have not priced in this potential move. Okay, so for example, for that Home Depot move, what did the market makers price in? Well, the stock actually ended up moving way further than the expected move. You can see right here that the expected move 7 days out was $3. The expected move 14 days out was $4. So the out of the money options were priced 14 days out for an expected move of $4. Okay, that means they were pretty cheap. And in this case, instead, what happened is that, yeah, if there's not a squeeze, guess what? It is going the expected move. But then with the squeeze, instead of moving $4, it ended up moving $20. Okay, this is a very rare time when you can buy these really cheap out of the money options and actually hit pay dirt. Okay, because the stock is actually ready to have a greater than expected move, and so that's kind of a nice bonus if you're familiar with how options are priced. Okay, so now, so it's great when squeezes are smooth and they don't give us any trouble. But as I always like to say, this isn't Never Never Land. This is trading. There are certainly times when the squeeze sets up and is sloppy at best, or it consolidates longer than we thought it would. So in order to give us our own best chance, this is how I like to set these up. First, okay, and let's just assume a daily chart, but this could be any time frame. I like to see 3 to 5 of those red dots. Okay, one red dot, that's not enough. I want to see 3 to 5 to see that there's this building up of momentum. Okay, this building up of energy. Now, for bullish trades, I like to see that the moving averages are stacked positive with price near the 21 EMA. okay? It's, you know, at or above it. But basically, as we were talking about on the other slide, you know, you've got the 8 followed by the 21, 34, 55, 89. Okay, they're just stacked positive. In this case, what I do is after about 3 dots, 3 to 5 red dots, I just start buying bullish positions. Okay, so if it's an individual stock like Apple, I also like to double check and see if the sector XLK or the index QQQ is in a squeeze. Now, oftentimes it's not, but if they are, if all three are squeezing together, that's when you're going to get by far the biggest and most consistent moves. On those moves, I will double my position size. It's like, man, not only is Apple in a squeeze, but its sector XLK is in a squeeze, and the entire index that it trades in, the QQQ, is also in a squeeze. Okay, when they all three line up, I call that a triple squeeze. It is very, very powerful. Okay, and of course, if the stock index goes, most of the stocks in that index are going to go as well. So of course, I always want to know if the indexes of themselves are in a squeeze. Okay, the goal with this is to participate when it triggers. I always say, when you got a good setup, don't be a dick for a tick. In fact, that's our company motto. We have t-shirts that say the very same thing. We have a high probability of an expansion move. Whether you get the option for $3.50 or $3.70 or $3.20 or $4 is immaterial. Okay, if you've got the setup, grab the trade. All right, so we get in our positions and we wait. The biggest danger is that it just stays in a squeeze for longer than we thought, and the stock just keeps trading sideways. So if you load up on a bunch of out-of-the-money calls that expire in 15 days, you're going to lose money during that time. Okay, so you want to construct your position in a way that it can withstand a couple of weeks of chop, because you don't know exactly when it's going to trigger. So this means buy them further out. Even though the trade's only going to last 8 to 10 days after it triggers, you know, buy options that are at least 30 days out or more so you can survive that chop. Or if you're a more advanced options trader, you can do things like sell some put credit spreads and construct simply what I call theta positive positions to take advantage of that. So a couple of examples here. So for Amazon, so in terms of constructing these trades, for Amazon, I bought calls and sold puts via spread. Why? So the first thing I did is I bought the 490 calls. All right, in this case, I flipped them out and booked $5,800. But then I also sold a put spread. So why do I do it like that? Because if there's that initial big move up in the squeeze, great, I can use that move to get rid of my call options. Typically, if my call options double, I want to get rid of them, right? That's fine. Sometimes I'll hold on to them for longer, but then I can continue to hold on to that put spread. So in this case, if that makes sense. So, you know, I always like to have, if it's a long trade, I'll like to buy some calls and sell some puts and kind of get the best of both worlds there. And of course, the opposite on bearish trades. Also, the other thing I want to show you here is that when you have a squeeze like this, how much it impacts the chart. So here we are on Chipotle, consolidating, consolidating, consolidating. We have this big move higher, okay? And now here we are consolidating, consolidating, consolidating. This time it fires short, big move lower, consolidating, 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 big move short. Now, what happens when we throw the Keltner channels on this? Okay, you can see that it destroys it. All right, so you've always got to be aware of the squeeze. So again, if there's not a squeeze, great, you're going to be playing this all day long. But when there is a squeeze and it fires, it blows through it and resets itself. Okay, in this case, there's a squeeze, it blows through it and resets itself. Here's a squeeze, it blows through it and resets itself. So the beauty of this is that not only if there's not a squeeze, okay, and there hasn't been a squeeze for a while, all you got to do is just sit there and bing, bang, bong, back and forth between the Keltner channels and the mean. But then when there is a squeeze, just understand that it can blow through those levels, okay? And that's what most people who trade reversion to the mean don't understand. They're like, oh my God, I can't believe it did that. It's like, really? There was a squeeze. What's a squeeze? Okay. So the good news is time frames don't matter. A squeeze generally lasts 8 to 10 bars. So a weekly squeeze means you could have a move that could last 8 to 10 weeks. Right now, there is a monthly squeeze in Tesla. That's super interesting. There's a monthly squeeze in the Japanese yen. That's super interesting. When they do fire, you're talking about an 8 to 10 month signal. Okay. A 30-minute squeeze, I love those. That's like a 4 to 5 hour trade. Sometimes you stay in it overnight. Sometimes you don't. Let's see here. Let's take a look at LinkedIn. Studies. Add studies here. And then let's look here. Oh, yeah. If you want to look at, we'll look at some stuff. We can actually look at anything you want to. Add study. I am looking at John Carter studies, squeeze. So if we look here at, there's a recent one we did in, was it Netflix? So same thing here. So here's Netflix right now. So 30-minute squeeze, very sweet trade. This is where it went from about $275 up to $319 before it ran out of momentum. So yeah, so it doesn't, some of the examples I have are just a little bit older just because I don't want to recreate a presentation every time, but in terms of the science behind it or the math behind it, it has not changed. And then one I've been watching as well, like on the bond market, if you trade futures, this one's been a lot of fun. Squeeze right here that's set up. You had a nice explosion higher, and now just kind of waiting to see on some longer term time frames which way it's going to go. And Gilead, I think that was that one. Yeah, those are just a couple of examples there. AutoZone, that's always a fun one. That always has crazy moves. So in terms of managing these trades, targets, channels, and Fib extensions, I'm a big fan of Fibonacci extensions if you're familiar with those. So like say the 1272 extension, all that kind of stuff like that. The main thing with this strategy is just to learn to be okay with leaving money on the table, all right? Sometimes you're gonna take some off, take the easy profits, and you might see it keep running, but I'm a big fan of just scaling out on the strategy. You get into the squeeze, if you get 2 ATR away, great. Take half off, trail up your stop. More than likely, you're gonna continue to get some more action out of that, okay? And from there, yeah. And I always say, I always love to trail stops. Let nature take its course and your tools will strike at the right moment. All right. So anyway, so hopefully that kind of helped. Just the idea with this is just kind of stay calm and this kind of stuff. For those of you that are not familiar with this, we are going to be doing a free 2-day open house in our live trading room starting tomorrow. So that's the 15th and 16th. If you'd like to see how we do this stuff live, we'll be sending out trade alerts. You'll have live chat with other traders and stuff like that too. And if you would like to join us for this, again, this is free. You've seen one of the 2 strategies that I like to use. If you would like to see me trade these live tomorrow and Wednesday, and how our other traders and the setups that they use, again, we're going to do a 2-day open house. If you just go to simplertrading.com/open, you can sign up there. Again, totally free. We'll make sure that you get trade alerts as well as we do this stuff. And then it just gives you a chance to ask questions. Is there something else there that you would like to see? And then after the 2 days is over, great. You can leave and go along your merry way and just, hopefully you've got a little bit more tools in your toolbox so that you fully understand what's going on in these current market conditions and that you are able to trade it. Okay? Will the open house be recorded to watch later? I believe it will. I believe, yeah, we always like to record everything that we do. Are these covered in your book? So the squeeze is definitely covered in my book. Reversion to the mean, that concept, definitely covered in my book as well. Cool, Joe. Yeah, no, it's good. I mean, again, the open house is nice. It just kind of gives you a chance to see what's going on in these current markets. We've been trading the weed stocks in January, doing some of the tech stocks and things like that. I'm looking for the markets to kind of slow down here for a little bit and pull back. So I've been selling some call credit spreads as well. And yeah, we'll kind of see what's shaking up for tomorrow. And if you are already in our room, you don't have to do anything. So yeah, it's going to be, if you're already in our room, you don't have to do anything. Just show up as normal. There's some folks, for folks that are not in the room, if they want to get a chance just to kind of look over our shoulders for the next 2 days, this is kind of that opportunity that we do once in a while, and just hold an open house where they have the ability to do that. Oh, so the book I have is called Mastering the Trade. It just came out with a 3rd edition, and that is on Amazon. However, I believe we may, during the open house, we may actually have something that we're doing where you could actually get copies of that book. So you might wait a day or two, but is there beer? The nice thing about trading online is that there's always beer if you want it. Yeah, I believe we actually may end up doing a futures open house too here in the next couple of weeks. The futures market has been fun. Did you update a lot from the second edition to the third? Yeah, parts sections 1 and 3 are totally updated. The middle parts is fairly similar. Just some minor updates there. All right, great, guys. Well, thanks for joining me. Again, I'll leave this slide up. If you go to simplertrading.com/open, that gives you free passage to our trading room tomorrow and Wednesday. Again, it just gives you a chance to see what we do more in real time, add a few more tools to your toolbox, understand kind of how to do these things, and hopefully, again, kind of set you up for an awesome trading year. I believe, Neo, that it is already available in the Kindle, I believe. Thanks, Java. Yeah, we will tee this up. I think everybody who maybe registers maybe get a copy of this presentation, so I will save this so they can do that, and then we'll get that all teed up and go from there. All right, guys. Well, thanks for joining me. For those of you that are going to join us in the open house, looking forward to seeing you there tomorrow and Wednesday. And as always, good trading.